Welcome back to the trading desk. As your lead analyst, I'm here to guide you through today's explainer. Look, we're stripping away the guesswork, the emotion, and the endless reliance on lagging indicators. Instead, we're going to walk through a strictly rule-based blueprint for mastering market structure and risk management. If you're ready to stop gambling and start executing like a pro, well, you're in exactly the right place.
All right, let's just quickly run through the agenda. We're hitting the swing trading framework, decoding true market structure, identifying key trading zones, calculating position and risk, and finally, the risk-to-reward rule.
Starting off with Section 1, the swing trading framework. We got to define the temporal scope and objective of our methodology right out of the gate. So, our battleground is swing trading. Unlike day trading, where you're frantic, entering and exiting in the exact same session, we're actually compounding returns by capturing those multi-day fluctuations. We're talking holding an asset for a few days to maybe a couple weeks. The whole objective? Buy the troughs to ride the upswings, or short the peaks to ride the downswings, always trading with that broader market trend.
Moving right along to Section 2, decoding true market structure. Let's talk about identifying actual trends without letting emotion take the wheel.
So let me ask you a serious question. Are you misreading the market trend? You know, most retail traders are taught early on that an uptrend is simply higher highs and higher lows. Easy enough, right? But what actually happens when a chart suddenly drops and breaks a recent low?
Well, that's exactly where the amateur mindset completely diverges from the analyst mindset. Amateurs see a slight drop, they panic, and assume an immediate downtrend reversal is happening. They start aggressively hunting for short trades. But an analyst, we validate true market structure before we ever abandon an uptrend.
And that brings us to this absolutely crucial rule. Listen to this. A low is only validated if it breaks the previous high. I'm going to say that again because it's the bedrock of this whole strategy. A low is only validated if it breaks the previous high. If a price dips but doesn't break that previous high, it is not a valid structural low. So if the price drops below it later, the uptrend remains completely intact. It's wild how many people get shaken out by that.
To strip away the guesswork entirely, we run a strict three-step process based purely on price action. Number 1, identify market structure. Number 2, locate supply and demand zones. And number 3, calculate risk to reward.
Which brings us to Section 3, identifying key trading zones. Once our structure is validated, we have to find exactly where that institutional capital is resting.
Here's the deal. We only look for demand zones, which are areas where we exclusively want to buy, in confirmed uptrends. Conversely, supply zones, where we only look to short, are found in confirmed downtrends. Frankly, trying to short in an uptrend is just silly. You always trade in the direction of the confirmed trend, period.
So how do we actually pinpoint these zones? Well, first, you find an area of price consolidation. Then, you mark the specific candle right before a sharp impulse move. That explosive move tells us a ton of buyers are sitting there. Then, we wait. We just patiently wait for the price to re-enter that marked zone. Once it does, we place our entry and, crucially, put a stop loss just safely outside that zone.
You know, as analysts, we also look at classic setups. Take a bounce on Honeywell, for example. Price hits a support level of $170, and your target exit is the previous high of $200. That's a potential $30 per share. Or maybe a breakout on Schlumberger. It breaks a $44 resistance, and since it was in a $6 range prior, you project that out for a very precise $50 target exit.
All right, Section 4, calculating position and risk. Identifying a beautiful setup is totally useless without rigorous mathematical risk management. 1%. Embed this in your brain. As a strict rule on this desk, we are willing to risk absolutely no more than 1% of our total trading portfolio on any single trade. No gut feelings, no just this once exceptions. 1%. So how does that translate to position size? It's portfolio risk divided by trade risk. Simple. If you're running a $50,000 portfolio, your 1% risk is $500. You divide that by, say, a $2 trade risk between your entry and your stop, and boom, your exact maximum position size is 250 shares. It takes all the emotion right out of it. Now, you absolutely always have 2 exits planned before you even enter, one for profit, one for loss. That stop loss is your proverbial line in the sand. But keep in mind, a triggered stop order turns into a market order, which means your actual fill price might differ from your trigger price if things are moving fast. You've got to account for that slippage. Finally, Section 5, the risk to reward rule.
We have to evaluate if the mathematical upside actually justifies our capital exposure.
This is our ultimate filter. We demand a minimum risk-to-reward ratio of 1 to 2.5, meaning for every $1 we risk, we are positioned to make at least $2.50. Risk $100, you better be aiming for a minimum of $250.
Actually, scratch that. It's more than a filter, it's a hard rule. If the risk to reward is under 2.5 to 1, do not take the trade. Period. Even if literally all other setup conditions are perfectly met. Risking $2 just to make $1, that's unacceptable math. And as analysts, we just walk away.
So I'm going to leave you with this. Can you strip away emotion and trade strictly by the numbers? When you replace gambling with validated structure, precise zones, and unbreakable math, the only question left is, do you have the discipline to follow this analyst's blueprint on every single trade? Master these rules, and you'll completely change the way you see the markets.